Welcome to another episode of our podcast. I'm Elvira Rodrigues, mortgage expert and real estate investor. And it is always a pleasure to have you here with us. Before we begin, don't forget to follow the channel and hit the notification bell so you won't miss any future episodes. And of course, if you'd like to connect with me on social media, you can find me at Elvira Loans. Today, I am so happy and thrilled to welcome back my business partner, Armando Aviles. Armando is a seasoned expert in real estate financing, and he is here for his second appearance to dive into the world of DSCR home loans. This financing option is perfect for property investors, offering incredible flexibility for those looking to build or expand their real estate portfolios. Welcome, Armando.
Thank you. I appreciate the opportunity to talk to you about DSCR loans.
Yes, and tell us, what is a DSCR loan?
Well, do you know what DSCR stands for?
The debt coverage service ratio.
It stands for debt service coverage ratio, and a DSCR loan is a loan that the ability to repay component is calculated on the cash flow of the subject property.
Okay. So a cash flow is if the payment is $1,000, then it has to at least be the $1,000 for rent.
Right. So the cash flow is referring to the amount of cash that the investor has in the property in question. So the actual formula for DSCR is rental income divided by the payment.
Okay.
Ideally, you want that rental income to cover the payment on a one-to-one basis. For example, if the payment's $2,000 a month, then you're going to want the rent comps to come in at $2,000 a month.
Best would be if they have more, because then they have really a cash flow. Because the cash flow is going to be the what is left after paying the mortgage, right?
Exactly, and we're talking about minimums here. So we ideally want the payment to cover the rent to cover the payment. And
yes.
For the most part, it's going to exceed.
So what is the minimum credit score? Is that a fixed minimum credit score that a borrower has to have?
Well, it depends on the loan to value that you're looking for, but for the most part, a 660 is going to be enough.
Okay, so the loan to value, just so the people that don't understand what that means, is if the house is worth $100,000 and you are borrowing $75,000, that is the loan to value is $75,000. So it depends on how much they are putting as a down payment.
Correct.
Okay.
Correct. Yes.
All right. What is the minimal down payment on DSCR?
So the max that you're going to be able to finance is 80%.
Okay.
On a DSCR loan.
Okay. So the more money they put down, the better the rate too.
Exactly.
Assume, right?
Yes. Yeah. It's rate and risk is driven by loan to value. So the more money that they have invested into the property, the less risk there is in that loan. So the pricing will be better and the rate is.
Do we need to show income or employment? How does this program work?
No, there's no income and there's no employment. As I mentioned earlier, the ability to repay component is met by the cash flow of the subject property. So we're not looking at income or employment,
not looking at any
which
of
is
that.
one of the features of this program that makes it so attractive, is that there's no income, there's no tax returns, there's no employment. Yeah.
And that is great for the self-employed, because usually, they are trying to report taxes and they don't report enough to buy a property. So that would be an awesome program for self-employed. But can a W-2 employee also use a DSCR to buy a house?
Exactly. Again, so we're not looking at the employment, so we don't know if they're self-employed or if they're W-2'd.
Oh, okay.
So, yeah, it's attractive to all. I mean, W-2 or self-employed, your savvy investor that has a bunch of investment properties, or your investor that's looking for their first investment property.
Yeah. So if they are a first-time investor, can they get a DSCR loan?
They sure can. They can be a first-time investor. They can be a first-time home buyer.
Oh, so if they're a first-time home buyer, they don't own any property, can they buy a property on a DSCR loan?
They can. They can buy an investment property going DSCR as long as they have 12 months of rental history.
Rental history. So if they they wanted to buy to live in it, this is not the program
Exactly.
for them.
So this program is strictly for investment property.
Yes.
So in the scenario that you mentioned where the borrower doesn't own a home, the purpose for the property in the home has to be investment property.
Okay. All right.
Excuse me.
But that is amazing that, a first-time buyer can actually buy an investment property through a DSCR loan.
Exactly. When you think about, the scenario where you have your young professional that rents, but that has liquid assets and wants to get into the real estate market, that's a good borrower.
Yeah.
And it's a great vehicle, the DSCR loan is, for them to start investing in the real estate market.
Yeah. And I believe I have done some of those programs, the DSCR, for up to 4 units. Do you guys go only up to 4 units or more units?
No, we can go up to 8 units on a DSCR.
Nice.
Yes.
Nice. Okay.
We could do condotels, mixed-use properties. So, we can go up to 8 units. It's more common to see your 1 to 4 units, 4plexes. It depends on the part of the country that you live in, but 4plex DSCRs are
awesome.
are pretty big, yeah.
And the great thing about a 4plex is that if 1 or 2 units are vacant at a certain point, there are still 2 other properties that is bringing in the income to cover the mortgage.
Exactly. So you're talking about cash flowing. A 4-unit property on a DSCR is definitely going to cash flow.
For the first-time investor, what is a cash flow and how do you calculate that?
So for a first-time investor, they do have to, the property does have to cash flow at a 1-to-1 minimum. When you think about the dynamics of a first-time investor, we have to, from a risk standpoint, we have to make sure that property is going to rent
and cover
the payment, right? Especially since that particular borrower doesn't have any experience managing an investment property.
Okay, awesome. So minimum of 20% down payment.
20% down.
And if you put more, you can have a better rate.
The more, the better. Yeah. The more that they come into the loan with it's gonna the risk goes down and pricing improves.
And if they have other properties, like as their own investments already, let's say that they are experienced investor. Do we have to count the rental incomes on those properties or no?
Well, not from a qualification standpoint. We are going to look at the other properties to make sure that they're current on their taxes and insurance and there's not any mortgage lates if there's mortgages on them. But from a qualification standpoint, we aren't considering the other properties.
Yeah, but that would, the existing mortgage would show on their credit. But also if there is any problem that was a owner financing, then they have financing with the owner. So probably we'll have to show the notes, right?
Right. And again, we just have to have proof that everything is on time.
It's on time.
No late payments, taxes, and insurance are current. Yeah, but from a qualification standpoint, we're not going to consider the other properties. We're only looking at the subject property for qualification.
What if the rental income comes negative?
So we do have options to if the rental income does come negative, we have an interest-only option, where we'll use the interest-only payment plus the taxes and insurance to calculate the DSCR. And we can also get creative with the prepayment penalty types. Okay. You can go longer on the prepayment penalty to bring the rate and the cost down and that helps us it makes it easier to accomplish or achieve that 1-to-1 DSCR. But even if after all of that you're still negative on the rent comps, we have options for you. So we can close it and it's a negative DSCR.
Okay. And so you were talking about you can get creative with prepayment penalties. So let's say that we need to do that. And I've heard that you have like a flat and a standard prepayment penalty. Can you explain that on that?
So a standard prepayment penalty is 6 months interest on 80% of the original principal balance. And the flat is a 5% flat fee. Okay. At the time of prepayment.
When do you use the flat or the standard? You choose at the time?
I recommend, or we have different, and that's the beautiful thing is that you have different options that you can play with that will fit the particular borrower's needs and future plans for the property. I always recommend starting at a 3-year with the flat prepayment penalty. That prices out the best in our system. But they do have options, and sometimes if you're going to a 2 or a 1 year, you can't go to the flat prepayment. You have to get the standard.
Okay.
So and it just really depends on the particular scenario.
Yeah. And if they are not planning really to show proof, I mean, they can just choose the 3 years because it gives a better rate.
Right.
And 3 years goes by so fast as well.
Exactly.
Right?
And that's why I mentioned that I always want to start the pricing at a 3-year flat because that's what prices the best. And so I always recommend to my loan officers to let's consider the 3-year flat prepayment.
And can they buy down or buy out? I would say not buy down, but buy out the prepayment penalty.
They definitely can. And that's going to increase the cost and
Wait.
fees on the loan. But, and again, it just depends on what the borrower wants to do.
If it makes sense or not.
If it makes sense, if their plan is to hold it, then,
why do that?
Why
right?
do that?
Why
Yeah.
pay up front for something
Exactly.
that they might not even happen?
Exactly.
Right?
Exactly. Yeah.
Yeah. Is a DSCR good for a fix and flip?
So DSCR is not a good program for fix and flips simply because of the prepayment penalty component that comes. It's pretty much standard. And when you look at the nature of a fix and flip, the purpose is to get rid of the property. DSCR is a program for when you're going to hold the property. It's for your savvy investor or your first-time investor that wants to get into the market and wants to
hold
the properties. Yes, as rentals.
Yeah, because usually the fix and flip, they're going to turn over that property within 3 to 6 months max.
Exactly. Yeah.
So if they go fix and flip, then it's a different program totally.
Exactly
for that.
Yeah.
If they buy the property on the SCR, how long do they have to hold ownership on it to refinance?
So, and again, the whole prepayment penalty depends on their prepayment penalty that they go with, and when they want to refinance. So.
But also, I think it would only make sense if rates drop drastically to make that change.
Yeah, you have to calculate the difference in the payment and the rate and cost when it comes to that scenario. And again, for the most part, these borrowers that are doing the DSCR loans are in it to hold for a while. And if rates drop dramatically like that, then you as a loan officer has that conversation with the borrower to determine what's the best option for them.
If a borrower bought a property on a hard money loan and they decided to just keep the property, right? And they want to refinance now. So what can they do that?
Yeah, they can definitely. We can definitely refinance out of a hard money loan, and I see that a lot. And hard money lenders are a great referral source for you because for the most part, they want to get those borrowers out of their hard money so that it frees up that capital so that they can lend it elsewhere themselves. Yeah. So refinancing out of a hard money in a DSCR loan is common. You see that a lot.
And I believe there's a difference between rate and term and a cash out refinance, right?
Right. So if you're going rate and term out of a hard money, you're going to have 6 months seasoning on title to be able to use appraised value. If you're refinancing before that 6-month period, you're going to use the acquisition cost to determine the loan to value.
Just to explain to our audience is rate and term is when let's say you paid $150 for the house. You spend $50 to fix, right? And then the rate and term in reality, if you are gonna do before the 6 months, they have to go with the acquisition value, which would be the $150.
Right. And so in that scenario, typically the reason for them to buy hard money is that if they had a great deal on a property and they needed to pull the trigger on that property immediately. So you're going to use hard money to buy, and then you're immediately going to refinance out. Mm-hmm. So in that scenario, you're not looking at improvements on the property because it's already, you got a good deal on it. Mm-hmm. So you're going to go off of acquisition cost to determine the loan to value. And it's just a straight rate term refinance. You're just refinancing to pay off the hard money loan into a more permanent vehicle, which is the DSCR
And
loan.
if they want to do a refinance and have a new appraisal, then they would have to wait the 6 months.
Right, correct. So if they bought it and in a hard money and they held it for 6 months, then we could use appraised value to refinance. But there's several different scenarios there. There's oftentimes you see a borrower will buy cash. Or hard money, and then we do what's called a delayed financing.
Can you explain a little better what
so delayed
that
financing
means?
is basically a form of a purchase. We treat it as a refinance.
Okay.
So let's say they used cash for whatever reason. They got a really good deal. Hey, I have the cash. I'm going to go ahead and buy it. I want to recoup part of my investment, and it's been less than 6 months. Well, we're going to use the delayed financing feature on a DSCR to help them recoup part of that cash.
But they wouldn't recoup the whole thing. It would be a
No,
percentage.
it would be a percentage, right?
Because we are below the 6 months timing.
Right, and you're using the acquisition cost versus the appraised value because of that. But there's another scenario where they bought the house, hard money or cash, and they did improvements.
They're
A
remodeling.
rehab. Yeah,
Okay.
remodeling. So on a rehab cash out refinance, we don't have to have the 6 months.
Okay.
But with the caveat that the rehab has to be reflected on the appraisal, and we have to have confidence score in that appraisal.
Okay.
But we do have the ability to not have to go 6 months.
Armando, if they bought a house and they remodeled that property, can they get a cash out on it?
They sure can. As a matter of fact, we have a rehab feature on our DSCR program where as long as the rehab is reflected on the appraisal, they don't have to wait 6 months to go off of appraised value to determine the loan to value.
So they could recoup even more than what they spend there.
Exactly.
The DSCR loans, does it require reserves?
So certain situations do. We have features to where if the property is cash flowing, then we have options to where it doesn't require. So it's specific. So it's specific to the transaction.
Okay. Is there a prepayment penalty to not have the reserves? No, right?
No. The prepayment penalty is not going to affect
just
the
for-
reserves. It's the cash flow.
I'm going to ask this question because I have done it on Fannie Mae, Freddie Mac, where you can get gift from a family member. So let's say I own a property, right? And my son wants to buy a property. And let's say that I sell that property to my son. I can actually give him all the equity on that house.
Correct.
Right?
And that's something that's fairly new in the DSCR world is allowing gift of equity.
On investment property, because usually it's not allowed.
Exactly. And not only do we allow a gift of equity, we allow gifts. 100% gifts to where
really?
they don't have to the borrower wouldn't have to bring any of their own money. It could be gift funds from
No
mom and dad.
minimum from the borrower.
Right. So can you imagine a scenario where it's a first-time investor, first-time home buyer, where they're getting a gift from their parents for the down payment and reserves?
Even if it's not a parent's house.
Right.
Okay.
Yeah.
Because I have done some loans there, it's a family gift.
Right.
Then, they, both of them, come to the table with zero.
Right. So there's a difference between gift of equity and gift funds. A gift of equity is a scenario where you own a home and you're selling it to a family member and you're gifting them the equity.
Okay.
Then the gift funds is they're not necessarily buying a home from you. They're buying their first investment property or they're buying an investment property and you're giving them a cash gift to help them do that.
Oh, that's pretty nice.
Yeah, it's pretty awesome. Yeah, it broadens the scenarios that you can say yes to versus.
And a lot of people don't know that this, that this option exists.
Exactly, and that's why it's so awesome to do these podcasts because you can educate investors, and maybe somebody was on the fence or I can't. Somebody's been turned down. I can't. You can't do that with gift money. Now you can say yes, and that's another borrower for you.
That is awesome.
Yes.
Borrower on a DSCR, they always have to prove rental or housing history, right?
Right. It can't be rent free.
Okay, cannot be
So,
rent free. Cannot just be living with a family and then I want to
living
buy a
at home with
house
mom
and get
dad.
a DSCR.
Exactly. No, they can't do that. They have to have 12 months rental or they have to own a property already.
Oh, okay. Is there a specific or minimum trade lines that the borrower has to have to qualify for the program?
There is. So we have to have 2 trade lines for 12 months with one borrower. If there's only one borrower, And if it's 2 borrowers, we require 3 trade lines with that activity in the last 12 months.
So it's 2 of 24 or 2 of 12?
2 of 12 with activity in the last 12 or 3 of 12 with activity in the last 12.
Okay. All
depending on the amount of borrowers. But we have flexibility there.
Okay. So I deal with a lot of investors. I know a lot of investors, and majority of them, they wanted to buy a house and want to buy it on their LLC. Is that possible on DSCR?
Yeah, it's definitely possible, and that's one of the other attractive features of this program is that they can have their title vested in an LLC.
And does it show on their credit if they buy with their LLC?
That's a great question, and it doesn't. So
wow, that is
I know
great.
That's great. That's another feature that's really attractive to your savvy investor.
So we do pull credit on them, but it does not show on them on the credit. It doesn't report to the credit.
Exactly. It doesn't report to the credit unless there's a default situation. But for the most part, it doesn't happen. We don't see that a lot, and it's not going to show up on their credit.
And let's say that an investor has an LLC and they have a partner, but the partner doesn't want to buy, so he wants to buy. Is that possible?
Yeah, not everybody has to be on the loan.
So they would have to sign some kind of agreement that they release the information.
Well, no, they're still part owner of the LLC, but they don't have to be on the transaction.
Oh, okay. All right.
And another feature is that when you see, like, let's say a husband and wife, they have an LLC. One has a higher score than the other, significantly higher. We're going to go off the higher score.
So we did have a loan that we did that on that loan. We did have 4 people on that loan.
That's right.
And we actually dropped 3 of them. They just signed at closing, but we used one with the credit because he had a higher credit score.
We used the borrower that had the highest credit score. I do remember that.
Yes.
They all had to sign at closing, but we only looked at from a qualification standpoint.
So that means that they are still, all 4 of them still own the property.
Because they're on the LLC.
And for one to sell, the others have to do the same thing.
Well, that's obviously, that's a transaction that's specific to them that we're not privy to. But for purposes of the loan, they're on the LLC, so that means that they own part of the property.
And that's a wrap for today's episode. I hope this episode has shed some light and this powerful financing tool and how it can be a fit into your real estate strategy, whether you're just starting out or you are a seasoned investor. Don't forget to follow the channel and hit the notification bell to stay in loop with us. If you have any questions or want to dive in deeper on the program, connect with me on social media at Elvira Loans. Until next time, remember, every great investment starts with the right knowledge and the courage to act. See you in the next episode.